It was December 2018. The S&P had been bleeding for weeks, the worst December since the Great Depression. I was chatting with a trader I'd been working with for months. He had his eye on Apple. On his chart, the price had finally hit his dream buy zone, the exact level he'd told me for weeks he was waiting for. But as the candles fell toward it, he got quiet. What if it keeps going? What if this time it's different? He'd already seen headlines screaming bear market and talking heads predicting another 2008. He froze. The price tanked his buy zone. He did nothing. By the end of the week, Apple had bounced nearly 15%. His setup worked perfectly without him. This isn't rare. In fact, I see it all the time. Traders with a plan, traders with an edge, letting fear override their rules in the moment that matters most. And the cruel twist? That same fear is often what creates the very opportunity they miss. If you've ever watched a perfect setup pass you by because your gut said not now, you know the frustration. In the next few minutes, I'm going to show you exactly how to break that loop, how to act with calm confidence even when the market feels like it's in freefall. You'll learn why most traders get hijacked by their own psychology, why emotional discipline beats prediction, and the specific tools you can use to keep your mind steady when everything else is shaking. My name is Ben, and welcome to Trading Psychology Wisdom, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. A lot of what I've learned about staying calm in chaos was reinforced when I read Calm Trader, Win in the Stock Market Without Losing Your Mind by Steve Burns and Holly Burns. In their book, they talk about how fear and irrational panic push prices down to some of the best buy points you'll ever see. Yet most traders can't pull the trigger when it happens. It's not about lacking a setup. It's about lacking the ability to act in the heat of the moment. That hit me hard, because I've watched it happen countless times. And I've been there myself. The market punishes hesitation just as much as recklessness, but for very different reasons. August 24, 2015, the day traders now call China's Black Monday. The Dow opened down more than 1,000 points. I remember staring at my screens as the market went haywire. ETFs mispricing, spreads blowing out, and my watch list bleeding red faster than my eyes could track. My plan that morning was simple. Buy into a few high-quality stocks if they hit key support levels I'd mapped out the week before. These weren't random levels. I'd backtested them, seen them hold in past sell-offs, and sized positions so I could survive more downside. But as the opening bell rang, the screens turned into a waterfall. One of my targets, Microsoft, dropped straight into my zone within minutes. The chart was screaming setup. My system was flashing green. But my gut was screaming louder. What if this time's different? What if it doesn't bounce? I froze. Watched the candle tap my level and reverse almost instantly. Within the first hour, Microsoft had recovered over 8% from that low. My plan was right. My process was right. My emotions weren't. I'd been through volatile markets before, but that morning I fell into the same trap I warned others about, letting short-term chaos override a long-term edge. And here's the kicker. Those wild open drops are often where the big money is made, if you have the discipline to act. Looking back, the loss that day wasn't in dollars, it was in confidence. Because hesitation becomes a habit. Miss enough planned trades, and you start questioning your entire system, even when it works. That's why I tell traders, staying calm isn't about pretending you're not afraid. It's about being prepared enough that fear doesn't get a vote in the moment. Burns puts it perfectly. The best dip buying opportunities come from panic, but only if you can step into the fear. What we're really talking about today is emotional discipline. The ability to execute your trading plan even when the market feels like it's trying to shake you out of your own skin. This isn't about predicting every turn or avoiding losses altogether. It's about building a process so solid that you can trust it when everything else looks uncertain. And just so we're clear, this is education and insight, not a signal service. Always do your own research before you put a single dollar in the market. Trading without emotional discipline is like sailing into a storm with no compass. The waves aren't what sink you, it's losing your sense of direction. When the sky darkens, most traders focus on the clouds. The calm trader focuses on the course, and the course is your system, your risk management, and your ability to act when fear tells you to freeze. One of the first truths you learn as a trader is this: the market owes you nothing. Not predictability, not comfort, not even fairness. I remember a guy I worked with back in 2020 during the COVID crash. He had a solid system, clean charts, and the discipline, on paper, to follow it. His buy zone for a major airline stock was set weeks in advance. The level hit on March 16th, the day the Dow fell almost 3,000 points. But instead of executing, he froze. He told me later, "I kept thinking, what if it keeps dropping? What if this is the big one?" By the time he convinced himself to buy, the stock had already ripped up 30% from his level. This is the trap calm trader talks about. Fear paralyzes you right at the point where the market hands you the best risk reward trade you'll see all month. It's not that the setup wasn't there, it's that the fear of more downside hijacked his decision-making. Behavioral finance has a name for this: loss aversion. Daniel Kahneman and Amos Tversky found that losses feel roughly 2.5 times more painful than equivalent gains feel good. That's why, in moments of panic, your brain is wired to avoid losing more rather than to pursue a perfectly logical opportunity. But here's the key. Expecting the unexpected isn't about predicting black swans or guessing bottoms. It's about acknowledging, in advance, that fear will show up right when you need to act, and building rules so you can still pull the trigger. For me, that means having predefined entry zones and preset position sizes before the market opens. When price hits my level, my only job is to execute. No debate, no hesitation, no, "let me check the news." I already decided when I was calm. Burns says it best: the best dip buying opportunities come from panic. You either prepare for that moment or you get steamrolled by it. Your choice. I used to think mindfulness was just a trendy word for meditating in a quiet room. Then I watched it save a trader's career. It was 2017, and one of the traders I knew had been on a 6-week winning streak. Every morning he'd log in, review his watch list, stick to his system, and trade without forcing anything. But one bad trade flipped the switch. He doubled his size on the next trade to make it back faster, then another when that failed. By the end of the week, he'd erased his gains and his confidence. When we unpacked what happened, it came down to this: he'd lost his emotional distance. He wasn't trading setups anymore. He was trading his feelings about the last trade. Calm trader puts it bluntly: a trader has to create emotional distance from the market's feedback loop of profits and losses. Without that, every green candle feels like you're a genius, and every red candle feels like the market has it out for you. Mindfulness isn't about ignoring your emotions. It's about noticing them without letting them drive. A 2020 study of 72 professional traders found that those trained in mindfulness techniques had a 23% faster recovery time from emotional stress events, meaning they got back to objective decision-making faster. Here's what that looks like in practice. Before I start my trading day, I do a quick self-scan. How do I feel? Am I nervous, overconfident, distracted? If I notice I'm off balance, I'll reduce my size or even sit out completely. That's not weakness, that's control. Mindfulness also means treating every trade as just one of many, not as a referendum on your identity. You are not your P&L. You are the operator of a system, not the outcome of a single candle. When you can see the market's noise without letting it pull you into its current, you can keep your footing while others get swept away. Burns is right. The calm trader is usually the winning trader. But calm doesn't happen by accident. It's built one mindful decision at a time. In my early years, I thought the hardest part of trading was finding the right setup. Turns out, the hardest part was not trading the wrong ones. Back in 2013, I was tracking a small-cap biotech stock that had been running hot on social media. Every forum was calling it the next big thing. It wasn't in my system. No solid trend, no clean risk-reward, no confirmed setup. But every time I opened my trading platform, it was staring back at me, up another 8%, then 12%. I could feel the FOMO clawing at me. Calm trader nails it. Self-control is doing what you need to do even when you don't want to. That week, what I needed to do was nothing. So I stayed out. A few days later, the stock cratered, down 40% on a failed trial announcement. If I'd chased, I wouldn't have just lost money. I would have reinforced the worst habit a trader can have: breaking rules when the temptation feels justified. This is where delayed gratification comes in. The Burns talk about passing up the small, quick win to make room for the bigger, higher probability win down the road. The same principle shows up in behavioral research. Walter Miskell's famous marshmallow test followed kids for decades and found those who could delay gratification went on to have significantly higher earnings and better decision-making skills later in life. In trading, self-control is your filter. It keeps you from oversizing after a win, from doubling down on a loser, from jumping into markets you don't understand just because they're moving. My personal guardrails are simple. If it's not in my plan, it doesn't get my capital. If I'm tempted to just try it, I close my platform and walk away for 10 minutes. If I wouldn't take the trade with real money, I won't take it on paper either, because bad habits don't care about account size. Self-control is boring. It's not sexy like calling a bottom or hitting a home run trade, but it's the glue that holds every other skill together. When new traders tell me they're confident about a trade, I always ask, confident in what, the market or your response to it? Most say, the market. That's the wrong answer. In 2006, I was trading a major bank stock ahead of an earnings release. My system had flagged a potential breakout, and the chart was clean. But I also knew the actual number in the earnings report could swing the price 10% either way in minutes. Calm Trader makes it clear. Your confidence should come from knowing exactly what you'll do, not from thinking you can predict what will happen. On that day, my plan was simple. If price broke and held above my level with volume, I was in. If not, I was flat. No forcing, no guessing. Earnings came out, the stock spiked, then instantly reversed. Because I was anchored to my process, I stayed out. A trader I knew, convinced the spike meant the quarter was strong, bought in heavy, only to watch it bleed 10% in under an hour. Behavioral finance has been warning us about this for decades. Barber and Odean's study on overconfidence found that traders who believed too strongly in their ability to know what comes next underperformed by an average of 11% per year. They weren't lacking intelligence, they were lacking respect for uncertainty. Here's the truth. You will never remove uncertainty from trading. But you can remove uncertainty about your actions. That's where calm comes from. For me, that means every trade has a defined entry, stop, and target before I click the button. I size positions so that even a string of losses won't take me out mentally or financially. I accept that sometimes I'll follow my plan and still lose, and that's fine. Traders who survive understand that they're not betting on a single trade. They're betting on their ability to execute a repeatable process over time. The market's uncertainty becomes less threatening when you're certain about what you'll do next. If fear is the silent killer of good trades, ego is the loud one. In 2014, I had a position in an energy stock that was going against me. It hit my stop, but I didn't take it. Why? Because I was sure I was right. I'd researched the fundamentals, read the quarterly reports, and even had a thesis I'd been talking about for weeks. Closing the trade meant admitting I was wrong, not just to the market, but to myself. So I held, and watched the loss double, then triple. By the time I finally closed, I'd not only taken a bigger financial hit, I'd done damage to my own discipline. Calm Trader warns that an unhealthy ego will balk at taking a stop loss because it can't stand to be wrong. It's not about the money anymore, it's about protecting an identity. That's deadly. The research backs this up. A study by Fenton O'Creevy and colleagues found that ego-driven traders tend to overtrade and oversize positions, leading to more frequent and deeper drawdowns. The need to be right clouds the ability to make objective decisions. The market doesn't know you exist. It's not judging you. It's just matching buyers and sellers. The only scoreboard that matters is your equity curve, and it doesn't care if you called it on a single trade. Here's how I keep my ego in check. Every trade is just a data point. Win or lose, I record it and move on. I never marry a stock. If it hits my stop, I'm out, no questions. I size positions so I'm never emotionally invested in proving myself right. The day I stopped caring about being right was the day my consistency started improving. Because my job isn't to predict, it's to react within the boundaries of my system. And that's something no ego can improve on. One of the biggest shifts in my trading came when I realized my struggles weren't unique. They were documented, measured, and studied. Take loss aversion. Kahneman and Tversky's prospect theory found that losses hurt roughly 2.5 times more than gains feel good. That means if you win 1,000, you feel a certain level of happiness. But if you lose 1,000, the emotional impact is more than double. That's why so many traders freeze right when the best opportunities appear. Their brains are wired to avoid more pain, not to seek logical gain. Or look at overconfidence. Barber and Odean's landmark study of 66,465 households found that the most active traders, often the most confident, underperformed the market by an average of 11% annually. Confidence feels good, but it's dangerous when it's built on prediction instead of process. Mindfulness? A 2020 study on 72 professional traders tested a simple daily mindfulness routine over 6 weeks. Traders in the mindfulness group recovered from emotional stress events 23% faster than the control group, meaning they returned to rational, system-driven decisions more quickly. And then there's ego. Fenton O'Creevy's research on trader psychology showed that those who linked their self-worth to being right took larger, riskier trades and suffered deeper drawdowns. Ironically, the more they tried to prove themselves to the market, the more they underperformed. We also see these patterns in market history. Flash crash 2010. Many traders froze or exited in panic as prices plunged in minutes, only to miss the equally fast recovery. COVID crash 2020. Massive fear created sharp declines and equally sharp rebounds. Traders who had rules and acted in the chaos captured once-in-a-decade entries. Oil collapse 2014 to 2016. Ego kept some traders holding long positions all the way down, convinced the bottom was near. Others who accepted the market's verdict and adapted preserved capital for the recovery. These aren't rare events. They're recurring psychological tests the market throws at you. The traders who survive and thrive aren't the ones who always guess right. They're the ones who show up with a plan, execute it, and manage their own minds better than the competition. That's why calm traders' core message hits so hard. In this game, your edge is emotional control. Everything else is secondary. After years of watching traders come and go, I've noticed that most blow-ups don't come from a lack of technical knowledge. They come from falling into the same 3 traps, over and over. 1. Fear-based hesitation. This is when you have the setup, the signal, the size, and you still can't click the button. The market's panic infects you. You start imagining every worst-case scenario, and by the time you act, the trade's gone. Calm trader warns, fear creates the very opportunity most traders miss. 2. Overconfidence and prediction. Addiction. Believing you know what the market will do next is intoxicating, until it isn't. Overconfidence tempts you to oversize, ignore stops, and tie your identity to being right. Research shows it costs the average trader over 10% in returns annually. 3. Ego-driven. Holding. When a trade goes against you, an unhealthy ego will fight to prove you were right. You stop looking at price action and start defending your thesis. Instead of cutting a loss, you let it grow and grow. The market isn't punishing you, you're punishing yourself. These traps feel different on the surface, but they all share one root cause, letting emotions override the system. Your job isn't to eliminate emotion, it's to keep it out of the driver's seat. If you take nothing else from this talk, take these 2 tools. They're simple, they're boring, and they're exactly what keep me calm when the market goes off the rails. 1. The pre-commitment checklist. Before the market opens, I decide my entries, exits, position sizes, and stop levels, and I write them down. That way, when price hits my level, I'm not negotiating with fear or greed. I'm just executing a decision I already made in a calm state. This turns the trading day into a series of yes or no questions instead of emotional debates. 2. The maximum pain rule. I cap my worst possible day at a 3% drawdown in total capital. That means I never risk more than 1% per trade, and I limit myself to 3 open trades when conditions are rough. It forces survival to be my first priority, profit second. If you can stay in the game, the opportunities will come. If you blow up, you're dumb. Neither of these rules will make you rich overnight, but they'll keep you from making the kind of decisions that take you out of the game. And that's the real secret. Calm traders aren't fearless, they're prepared. Before you take your next trade, ask yourself, when fear shows up, do I have rules in place, or do I just see how it feels in the moment? If the market gapped down 5% tomorrow, would I freeze? Or would I already know exactly what to do? When I'm on a winning streak, do I start increasing my size because the chart says so, or because my ego wants to prove I'm on a hot streak? Am I letting the market's feedback loop define my mood for the day? Or am I treating every trade as one small data point in a much bigger process? And here's the one that changed everything for me. If I stripped away my P&L and just looked at my execution, would I be proud of how I traded today? You don't have to answer out loud, but your results will answer for you. If this talk hit home for you, don't just nod and move on. Put it into action. Here's your challenge. Write down one lesson from today that you know you need to apply in your trading. Drop it in the comments. Share this video with a friend who's been struggling to stay calm in the markets. And if this helped you, like, share, and subscribe so we can keep building a community of traders who trade with clarity, not chaos. Remember, the market will always test you. It will always tempt you. But you decide how you respond. Master your mind, master the market. Trade with confidence and live with calm.